PIMCO CEO Mohamed El-Erian said the other day that developed economies will stall over the next year as Europe slides into recession, which makes it, as Sarah's been talking about, all the more critical that policymakers get their act together to stem this spreading debt crisis. Well, Mohamed joins us now in the studio. Great to have you here finally.
Thank you, Betty.
So, Mohamed, you say finally European leaders get it, right?
Yeah, absolutely. They got bombarded this weekend in Washington at the annual meetings by people telling them, you've got to get your act together. You've got to, this is hurting us. This is getting out of control. I call it an intervention. When your friends and family come around you and they stage an intervention to wake you up into action.
Right.
So they went back to Europe saying all the right things, and now they've got to get it done.
Right, and that's exactly what Sarah's talking about, is what are they going to get done? What do they need to get done first?
First and foremost, they have to stabilize the situation, which means stabilize the banking system and stabilize Italian and Spanish yields. And today's action is good news. It helps that we are at the end of the quarter, so investors are very nervous. So there's lots of repositioning going on because investors don't want to go out at the end of the quarter showing that they missed a rally.
Right.
Okay? So Europe has a bit of a breathing space right here. Second, they've got to turn that from being just urgent to being durable, which means getting the mechanisms in place. And that's why leveraging the EFSF is so important.
Okay.
Third,
the Stability Fund.
The Stability
Right.
Fund. And third, and most difficult, they've got to make a decision. They've got to have the moment of truth on how they want the Eurozone to look like. Do they want it to be a fiscal union, or do they want it to be a smaller but stronger Eurozone? And that decision has to be made. And it's really a German decision. So we need to see these steps take place, and then we need the politicians to give the air cover so that the technocrats can continue to improve the situation on the ground.
But I don't hear in there, Mohamed, you talking directly about Greece and what to do about Greece. What about that?
I think Greece, and we have this image, Greece is like the toe that got infected. It didn't allow, it wasn't dealt with, and therefore the infection spread throughout the whole body.
Right.
And is now threatening vital organs. Greece is a toe. It's no longer an issue about Greece. I think it's an issue about the rest of the body. For the particular case for Greece, I see almost no state in the world in which Greece does not restructure its debt. Right? The question is,
so some orderly default for Greece then? Some
default, hopefully orderly.
Okay.
That's what we need. We need an orderly default, right? But they will default.
They will default.
They will default.
Okay, but you're saying that basically forget about the default at this point with Greece. What we need is to make sure that the banking system can withstand any type of pressure like that, right?
Correct. It's all about firewalls. It's all about firewalls. It's not what's inside, on the other side of the firewall. It's how strong the firewall is. Because Greece is going to default, and the only question in my mind is, does it exit the Eurozone or not?
And do you think it will?
I think if Greece were left to its own devices, and if Germany were left to their own devices, they will all agree that Greece should exit. They would all agree that Greece shouldn't have entered to begin with, that Greece today faces a massive growth problem as in addition to a debt problem, and that an internal devaluation, which means cutting wages by 30 to 40%, is simply not going to happen, and therefore Greece needs to reclaim its exchange rate in order to help it grow. So if we were living in a perfect world and if there were mechanisms, there's no doubt in my mind that Greece would exit the Eurozone. The problem, Betty, there are no mechanisms right now. So they've got to figure that out quickly.
But with all that you say, Mohamed, though, I mean, you know, if in fact there are firewalls erected for the banking system, and in fact we do see an orderly restructuring of Greek debt, does that mean that Europe will avoid a recession, or there will be still a recession in that region? I
think that there will most likely be a recession because
regardless,
because a lot of damage has been created already. Right? So the question is not whether growth is slowing in Europe. We know it's slowing. It's how much will it slow, right? And let's not forget that this is part of a synchronized slowdown of the global economy. And let's not forget that Germany got a lot of its growth from exporting to China. Right. And China's slowing. So we're going to live through 12 months of synchronized slowdown. Hopefully it will be a blip and will come straight back, but a lot depends on whether Europe gets its act together.
Well, we are back with PIMCO's Mohamed El-Erian, the CEO of the world's biggest bond fund. And Mohamed, just before the break, you were talking about how you do believe that Europe is going to slide into recession next year. So the question, of course, for us here in the United States is that going to infect us? Are we going to then slide into recession because of that?
It's going to infect us to some extent. So let's not forget that Europe as an area is the largest economic area. So we're going to have lower external demand. There's also going to be some uncertainty as to the claims that we hold on Europe. Fortunately, they're pretty small. So if you
among the U.S. banks,
among the U.S. banks,
you think
among
it's
the U.S.
manageable?
I think that part is totally manageable.
Okay.
What's not manageable, and let's hope Europe avoids it, is if Europe goes into some disorderly outcome and then everybody steps back from the global economy, right? That is what everybody wants to avoid, right? This notion of a sudden stop. Okay, that's what happened back in 2008. Why was the Lehman moment so bad?
Right.
It's because everybody stopped. I could not trust you anymore. I wasn't sure what was going on. So what do? I step back. And when everybody steps back, you get the fallacy of composition. The whole system starts freezing up. The pipes clog. So as long as Europe doesn't cause that to the rest of the world.
Well, how do they make sure they don't?
I think by making sure that the financial system continues to function.
Okay.
Right?
That there's
by
liquidity.
Liquidity, by creating these firewalls.
Okay.
And by distinguishing between bad balance sheets and good balance sheets. You know, Betty, the big irony in this global economy is that there are lots of healthy balance sheets. Multinationals are as healthy as I've ever seen them. Lots of cash on their balance sheet. They've termed out their debt. They're profitable. The middle class in emerging economies, very healthy. They have the wallet to spend, but not the will to spend, right? Sovereigns, the Brazils of this world, very healthy. So if we can find a way to engage these healthy balance sheets, the world would look much better. But if you have a healthy balance sheet right now, and you see the mess in Europe, you say, you know what, I'm going to wait.
But then it makes sense to you then that even though these companies are very profitable here in the U.S., so they have cash on the sidelines, they're not hiring. They're not spending that cash. And that makes sense to you.
From their perspective, it makes total sense, right? Because the cash gives you massive optionality. First, it's great defense, right? So you cannot be held hostage to someone else's stupidity. And that's really important. And secondly, it's great offense that at some point you can go in and buy companies, invest cheaply. So it makes total sense that those who have balance sheet right now, seeing all this uncertainty, that they hold back. Of course, it doesn't make sense for the system,
right?
Because the system suffers as a result of that.
But Mohamed, is there an entry point here in the U.S.? At what point would you enter the United States and start investing?
I would want 2 of 3 things, right? One is what we've called the Sputnik moments, that the U.S. political class realizes that we need to come together. We need to have a common purpose, a common vision, because the world has changed and the U.S. position in the world has changed. So if we see a Sputnik moment, that'd be one. Second, in Europe, a moment of truth, deciding what they want the Eurozone to look like. Do they want a fiscal union or do they want a smaller but stronger union? We need a moment of truth. And third, China and other emerging economies trusting their consumers, enabling their consumer to spend. Right now, China trusts its producer much more than its consumer. Right?
So when you start seeing domestic demand pick up in China?
When I start seeing domestic demand pick up. So if we get 2 out of 3, assets are really cheap. But you need 2 out of 3. 1 is not enough.
Okay, so that would be then the entry point into the United States. Now, the Sputnik moment did sort of happen, though, didn't it, earlier this summer with the debt ceiling and the raising the debt ceiling? Then you had the downgrade of the U.S. credit rating. We seem to have lost that momentum from what you call that Sputnik moment.
Yeah, so remember the Sputnik moment, right? There was 2 elements in the late 50s. One is us waking up to find out that the Soviet Union had sent up a satellite and realizing, wow, here's an event. But there was a second element of a Sputnik moment, which is society coming together to do something about it. So we've had the first issue, we've had the unthinkable happen, and the unthinkable was the politicians flirting with default.
Right.
And the unthinkable was the US stripped of its AAA, right? Now we need the reaction. We need to come together. My hope was that President Obama's September 8th speech was the catalyst. It's still my hope, but so far it hasn't galvanized enough of the politicians.
It hasn't. Well, we are back with PIMCO CEO Mohamed El-Erian for some final thoughts. And Mohamed, give me your take on what you think is exactly going on here in the equity markets. Why we're rallying so much these last few days?
So part of it is technical. People have to remember that we are at the end of the quarter. So put yourself in an equity manager's position. You're going to be putting out all your reports. The last thing you want to show is that you're massively underweight equities when equities have been doing well. So the minute equities started finding their footing and started going up, that sucks in a lot of people who are underweight, a lot of people who were short the equity market among the hedge funds. So there's a massive technical element going on.
So this is not a fundamental risk on trade that you're seeing right now?
There's one part of it's fundamental, which is the Europeans recognize they need to do something. They haven't actually done anything yet,
okay.
right?
And equity investors recognize that.
The equity investors recognize that, and the rest is purely technical, right? The real test is, will this hold beyond the end of the quarter, right? When remember that fund managers are human beings. Right? They worry about how they're perceived, etc. So don't underestimate the technical element to this rally.
Do you think this is going to hold? Do you think this rally will hold?
It will hold if and only if, and I can't stress that enough, the Europeans act quickly. The Europeans do not have much time.
So you're talking next few days?
I'm talking, yeah, days.
Days
Absolutely
that they have to act. Something coming out from the ECB?
Something coming out of the ECB and some willingness from the fiscal agencies to do more. So all these votes coming up, on Thursday we have a really important vote in Germany, right?
Right.
We have to have these things done, right? And we have to have a desire to do a lot more and actual detail. We don't have any details yet. All this has been on rumors, on speculation, and talk, etc. But there's no details yet.
Then how do you explain what's going on in the treasury markets, though? I mean, if this is technical on the equity side, you are seeing treasury sell off quite a bit today.
So all that people are doing is they're going from treasuries back into the equity market. So you're seeing a reallocation from the safe asset to the equity. The one thing that I find a little bit striking is gold. I would have expected gold to sell off today.
Yeah.
And yet gold is up.
Risk is coming back on, right?
So that's a little flashing yellow light out there, right? That if risk is truly back on, why is gold doing so well? Because the two assets that benefited enormously from all this risk-off trade, gold and treasuries, right? So it is a little bit disconcerting.
So that's flashing a warning signal to you.
That's flashing a warning. That and the end of quarter. So the calendar and the gold is a warning signal, right? That this is a technically driven rally. Let's hope that the fundamentals catch up. And it's all about fundamentals catching up with valuations.
Right.
Otherwise, valuations collapse back down.
Mohamed, quickly, Operation Twist. In the end, do you think it's going to have much impact?
I think it has an impact on what economists call the intermediate objective. So can the Fed deliver a treasury curve the way it wants? Yeah, probably.
Okay.
But will it have an economic impact? Will it actually change unemployment? Will it change growth? I don't think so.
The housing market?
The housing market, I don't think so.
Not at all.
The Fed needs help. Right now, the Fed is the only agency actually doing something. The others are missing in action.
Right.
And we need to see housing, we need to see credit, we need to see the Treasury get its act together. And the Fed has carried too much of the burden so far.
Okay, Mohamed, great to have you with us this half hour.
Thank you.
Mohamed El-Erian, the CEO of PIMCO.